Hi, I'm Scott Robinson, Director of the REIT Center at NYU's SPS Schack Institute of Real Estate. I am fortunate to be co-hosting the 7-part REIT leadership series with my friend and industry colleague, Robin Panovka. Robin co-chairs Wachtell Lipton's real estate and REIT M&A practice with Adam Emmerich, both of whom have long supported the Schack Institute of Real Estate, notably as conference co-chairs of our annual REIT symposium held every spring in New York City. For more than 50 years, the Schack Institute has been at the forefront of real estate education, guiding over 700 matriculated students annually through numerous non-credit and degree programs, including a Bachelor of Science in Real Estate, MS Real Estate, MS Development, and MS Construction Management. This REIT Leadership Series was designed to bring our students and numerous stakeholders into a direct conversation with some of the folks shaping our industry today, including Jay Brown of Crown Castle International, Tom Bartlett of American Tower, Aaron Block of Metaprop, Eric Bolton, Mid-America Apartment Communities, Stuart Tanz, Retail Opportunity Investments, Tammy Jones, Basis Investment Group, and Mike Landy, former CEO of Monmouth Real Estate Investment Corp. Importantly, I want to thank the many NYU Schack students who participated in this series and leaned in to prepare accompanying research around the conversations, including Ivan Chen, Emma Denhausen-Braun, Sam Penny, Jacob Bernstein, Ross Hewitt, and Cameron Spiller. Thank you. The topics of conversation among the CEOs in this leadership series are generally focused on each individual company's strategy, but I hope you'll see that they can also be categorized into major themes such as digital infrastructure, leadership, M&A, and specific industry trends. I hope you find these conversations and the related research memos informative, and I look forward to exploring these topics with you further on social media in the coming months.
This is an amazing company that Eric runs in two sweet spots, the Sun Belt and apartments. And we'll talk a little bit about how that has helped them fit through COVID and where it's all headed. Mid-America, just quickly background, over 100,000 apartments, enterprise value of over 30 billion, 21 billion market cap, and an extraordinary total return of 17% approximately over the last 20 years. So quite a run, quite a success story. And Eric, based on the recent earnings call you had, you sounded very optimistic about where this is all going. The results have been good, and I think you adjusted expectations upward as well. Let's unpack that a little bit. What's driving the growth and what's driving the optimism?
Well, really, just strong demand. Our history has long been, for 28 years, we've been focused exclusively on the Sun Belt markets, and really believing that over time that the demand side of our business is likely to hold up stronger over a full cycle. And these Sun Belt markets have continued to attract employers and jobs. And that job growth is really, I think, the key variable that drives demand for housing broadly in a given city or in a given market. And we continue to see a lot of evidence of good job growth, good recovery in these employment markets across the Sun Belt, and it continues to create more and more jobs. And so we're seeing migration trends that continue to favor the Sun Belt. Our move-ins from people living outside of the Sun Belt moving into the Sun Belt, we're up again a good bit in the first quarter of this year, even as compared to the first quarter of last year. And so it's been on an upward trajectory for the last 2 years, particularly during COVID. But these Sun Belt markets have continued to always historically generate good job growth and good demand growth, which is driving the overall demand for housing, including apartments. And then against that backdrop of growing demand, we're seeing continued pressure on construction cost and supply chain issues, which is, I think, creating more challenge for developers to respond to the demand with new supply. I mean, supply is definitely, trying to pick up, but a combination of, frankly, just supply pressures, construction cost pressures, coupled with a lot of these cities have experienced such growth, and particularly coming out of COVID. I mean, just the ability for these local officials and the inspection officials to come out and do all the things they have to do whenever you start construction, they're at full capacity. And so we really don't see supply pressures picking up in an appreciable manner against that backdrop of strong demand. And it's really therefore creating, a very healthy environment for us to continue to lease and raise rents.
And do you see this trend continuing? Is this essentially a bad sign for the coastal 24/7 cities that aren't in the Sun Belt, or is there room for growth everywhere?
Well, I think there is room for growth to some degree everywhere, but we have, as I said, we focused exclusively on these markets for the last 28 years, ever since we went public, and have just long believed that these markets tend to offer variables that employers find attractive. They tend to be generally fairly pro-business environments at both the local and the state levels. They tend to be certainly more affordable markets from a housing and overall cost of living perspective. They tend to be lower tax burden environments that I think are both conducive to job growth and migration trends. And it's been interesting to watch these cities transform over the particularly last 20, 25 years. As the growth has taken place, the appeal of these markets in terms of entertainment, restaurant, other sort of venues that really attract young people in the renter profile that we're after have continued to expand in a very positive way. So great quality of life that continues to improve, more moderate weather, just a lot of variables that I think are going to continue to attract employers and households to these markets. And I don't think that necessarily means that the coastal markets are in trouble. I do think that probably when you start to think about the variables that are going to define population growth potential for cities broadly over the next, call it 10, 20, 30, 50 years, it's going to come down to things surrounding affordability. It's going to come down to how these various cities are dealing with pressure surrounding crime issues, public education, and taxes. And these Sunbelt markets, I think, have done a pretty good job of how they've managed their financial stewardship has been strong, and they've been able to invest in these markets, in the infrastructure in these cities to a good degree. And I just think that how these cities broadly continue to attack some of these underlying variables that are so key to supporting and attracting population growth is what's going to really define success. And that can be accomplished in a Northeast market as well as it can be in a Sunbelt market. But I think some of these Sunbelt markets have done a pretty good job over the last 50 years to set up the stage for where we are today.
Yeah. So given all of those positive signs, one would expect, and we do read about competition heading you away from the other apartment REITs. You now have the non-traded REITs, the B REIT, the S REIT that seem to be favoring apartments in the Sun Belt, and you've got the single family home REITs now. Are you seeing a lot more competition for acquisitions, for example?
Oh yeah, it's been picking up a good bit for the last several years as the rent growth profile and the demand profile that I've been alluding to continues to, I think, garner more attention in the capital markets. And we have clearly seen more institutional capital migrating to these markets. And I think that that's likely to persist for some time. I think to some degree, if you go back a number of years ago, a lot of the cap rate differential that you saw between some of the high barrier coastal markets versus the Sun Belt markets, cap rates, I think, can be a function of a couple of different things. I mean, obviously, overall, sort of operating and rent growth prospects goes along, and your ability to, grow value in that manner over time goes a long way towards defining, what makes a reasonable cap rate for a given market. But the other variable that's at play in defining cap rates in a given market is going to be just how much investor demand is there, and how much investment capital wants to come into that market in a given market. And I think particularly with international capital that was so prevalent for so long coming into these markets over the years, even today, if I go to New York or Boston or wherever to see shareholders, and I start talking about a market like Birmingham, Alabama, it doesn't just generate a lot of sometimes enthusiasm, or Jacksonville, Florida, or Greenville, South Carolina. And as you can imagine, I used to I spent a fair amount of time meeting with investors over in Europe. And if I'm not saying New York or Boston, it's just conversation over. And
right.
So I think a lot of the capital that was coming into these markets, particularly from overseas, they went to markets where they knew, or went to markets that they had heard about. And I think that was, I think, to a large degree, to some degree at least, part of the influence on this cap rate differential, cap rate spread that persisted for so long over the last, call it 20, 25 years between the coastal and the Sun Belt market. Now, I think that's starting to dissipate, and I think due to a lot of reasons, I think capital broadly is starting to appreciate these Sun Belt markets more so than they have in the past. And as a consequence, I think the cap rate, the differential has compressed, and it's likely to be that way for some time.
So if that's going to make it harder to make acquisitions because the prices are just going to be that much higher, is development the way you generate growth? I see you doing a lot of redevelopment and development of assets. Is that kind of part of the plan?
Yeah, it is. For us, it really comes down to, sort of three things that we really are focused on from a growth perspective. One is development that you make reference to there. And we've got about $700 million or so under construction, under development at the moment. And we'll probably have that scaled up to a little over $1 billion by the start of next year. Although it's getting much more difficult. As I mentioned a moment ago, the pressures we're seeing with construction material cost escalation and just delivery issues is putting more and more pressure there. But development is a big part of our story. And then redevelopment, as you allude to as well, is also a big part of our strategy and our focus. And we've had that for quite some time. And, that's one of the benefits of seeing supply come into a market is, it's interesting, and more often than not, when you see supply come into a market, particularly over the last few years, as land costs and construction costs have escalated as much as they have, in order to make the development numbers work, almost by definition, the product being built in a market has to be a pretty high-end product. You have to get pretty high rents in order to get the return you need, given the basis and investments you're having to make with all the construction costs. And so a lot of the product coming in the market on average, we've seen is generally starting at rents that are 20-25% higher than the existing rents that we have in the markets where we are invested and have been for some time. And that spread between the new rents for the brand new product versus the rents we're at today is our field of opportunity, because we're able to go in, reposition a lot of our communities, upgrade the units in the various ways. When you walk inside, it feels like a brand new apartment, and we can raise the rent materially in order to get the return on capital that we need from the investment we're making, but still offer the market a real value because our rent level is still going to be less than where their rent level is by usually a big margin. And so the redevelopment is just a huge opportunity, and one of the benefits, frankly, of supply coming into a market. And then we do think as we get now in this environment where we're starting to see rising interest rates, and we just get later in the cycle, we do think that the acquisition opportunities are going to start to improve You know, we've seen a lot of high leverage buyers in the market for the last several years that have been able to get a fairly you know, low blended cost of capital. I mean, their equity returns are usually pretty high, but because they're able to borrow at such low rates on a blended basis, their cost of capital has been pretty competitive relative to our cost of capital. And I think that I think we'll start to see that change perhaps over the next few years as interest rates start to move back up. And I think our balance sheet and our blended cost of capital starts to capture more of an advantage as we move into later this year into next year.
You're touching on something that I think interests us students a lot, which is the difference between these high leverage buyers and the REITs. You're not that levered, but you came out of the travel crow world, so you've seen kind of both sides of this. Help us think through the private side of acquisitions with high leverage and also development as a private player as compared to a REIT. How do you think about those two? Who has the advantage when?
Well, you know, I think that the advantage depends on, you know, obviously where you are in the capital market environment at any given time, but it really starts with sort of what your objective is in terms of how you're trying to create an investment return on your capital. If you're trying to create an investment return on your capital in a private equity world, more often than not, you know, you are going to be looking at, say with development, you're going to be looking at using a lot more leverage in order to, you know, leverage your equity that much more. But more often than not, you're also looking at a shorter investment horizon. Where you're often, you know, going to build the development, get it stabilized, and then flip it, and you're going to, you know, own it for either maybe a 5-year period of time, a 7-year period of time, or maybe, as I say, you just get it stabilized upon development, and then you flip it right then. And so more often than not, a lot of your return on your investment is a function of the spread between your cost of basis and the cap rate at the time that you flip out of the property. And so a lot of your value creation is in the form of the exit, if you will. And there's a shorter investment horizon that you're thinking about. As a REIT, our approach and our considerations are different. You know, we're making investments with an eye towards a much longer investment horizon, because at the end of the day, as a REIT platform, what we're trying to do is drive value for shareholders over a long period of time, and more often than not, a lot of that value is a function of the dividend that we pay, particularly over a long period of time. You know, you alluded to our return on for shareholders over the last 20 years, which has been pretty strong. A significant component of that value creation is the dividend that we pay. And so, so we're able to go in and look at these opportunities with a much longer horizon associated with our forecasting, our planning. We're not looking to drive a lot of our value creation as a function of the exit transaction. It's really a function of the ability to drive rent growth and drive margin over the course of the whole period. So I think that one's not better than the other; they're just different. And I think a lot of it has to do with the horizon, investment horizon that you're looking at. And I think what we have found. I mean, as an apartment REIT, I mean, the stability of our income is pretty high and pretty strong. And if you just look at the business fundamentals, we probably could support a higher degree of leverage on a public balance sheet than we currently have. But at the end of the day, the public markets don't really favor that. And I can see over time how, frankly, again, with the long horizon, that the lower leverage that we tend to carry is actually a huge advantage at different parts of the cycle, particularly as you get into a rising rate environment with the cost of leverage starts to go up a good bit. Having the lower leverage on our balance sheet starts to create a cost of capital advantage for us. But more importantly also is, when you get into a recession or you get into a real down cycle, having that strong balance sheet and having that capacity on the balance sheet becomes a real advantage. And, I've often told people over the years that, over one of the things we've always tried to focus on and pride ourselves on is trying to create a return for shareholder capital that is outperforming our peers, but over a full cycle. So we always want to be this full cycle performer. And where value, I would argue, is really created for capital is usually when things are bad. That's when you hit the bottom, that's where the value play is. And that's where you want to be strong as a public REIT, is you want to be strong when things are bad. Because when it's good, hey, we're all good. But when it's bad,
Right.
we may not all be okay. And so that's the way we've always thought about it.
Yeah, no, that's where the balance sheet really, really comes in. As you said, you're thinking there might be opportunities with interest rates rising and so on in the next few years. So let me ask you about technology, and then I'll ask Scott and Sam to rejoin. But reading your materials, it sounds like you are quite aggressively converting the apartments into smart homes, employing prop tech in various ways. Tell us about that. What's the approach?
Well, I think that broadly speaking, our mission to sort of embrace technology and look for opportunity to drive more effectiveness, appeal, and efficiency in our product and our service and in our operation, is really anchored in my belief that that over, again, a long period of time, what becomes I think a real differentiator for companies and a real differentiator for platforms is the ability to drive higher NOI margins from the real estate versus what other platforms are able to do. And technology has continued to change the ball game in terms of how we are able to identify leasing prospects, how we're able to capture those prospects, convert those prospects into leases, and then serve and operate the property and serve the residents when they're with us. And so we're in the midst of literally challenging everything that we do on the operating side of the business these days, and thinking about, are there ways that technology that we know about or technology that maybe we can create can change something that makes the product and the service more appealing and makes our operation more efficient. And smart home technology is one example where we're able to go in and introduce some hardware into the unit. We then offer the resident an app they can put on their phone, which allows them to control thermostat, lights, the door lock. It also has leak detection devices that we put in the units that can alert them and us if we have any kind of a problem in that regard. And what we're finding is that our residents love the convenience of it. They love the, particularly if they're at work and they've got a friend coming over, or they've got a family member coming in, or they just, for whatever reason, want to grant someone access to their unit, the ability to do that via your phone and let them in and then, lock it back is a huge convenience. So we're finding that we're charging a $25 upcharge for that convenience, and people love it. And so it's creating increasing appeal for the product, but more importantly, perhaps, is that what the technology is doing from a foundational perspective in terms of our ability to manage vacant inventory, vacant apartments as people move out. We're able to and support ultimately complete virtual leasing and self-touring, so that, we can have a resident or a leasing prospect who indicates, they're living in New York and they want to move to Dallas, and they want to go tour one of our properties in Dallas. The ability for them to do that whenever they want to, 24/7, and for us to be able to, our leasing manager or whoever, be able to grant them access to the unit, turn the lights on, stage the unit appropriately with lighting and so forth, for them to come in and tour the unit and lock up after they leave, is a huge advantage. And it also has a lot of implications for, how we have to spend overhead to support that leasing activity. So there's a lot of foundational things that come from this technology that we think are going to really be advantageous over the coming years.
When you evaluate a technology like that, I assume there's a significant capital outlay for that. I mean, are you looking at returns on investment for each item? How do you evaluate them?
Absolutely. We go through a pretty rigorous return on investment analysis, like just in the same principles we use for how we buy or build a property. We go through the same process for how we build and buy and install technology. We want to get a return on that, and whether that is in the form of rent growth or whether that is in the form of expense savings, there's some kind of return on that. But one of the things that you have to be careful about, though, in this area that we've really come to appreciate, is that as you continue to embrace this technology and you continue to bring more of this technology into your platform, there's an infrastructure cost, a G&A cost, that you have to also sort of burden every new initiative with, because we've got more programmers, we've got more tech people that have to be in position, and then also you have to be very mindful of cyber risk and the issues surrounding that. As you open more of your operation to web-based tools, you've got to be sure you're mitigating the risk the risk that come from cyber attack that comes with that as well. So there's a hidden cost there that you have to also be very careful with, and be sure that you're being honest with yourself and thinking about how the true cost of some of this technology.
Fascinating. Scott, Sam, let me hand it over to you.
Yeah, it's great. Thanks. Eric, as a quick follow-up to Robin's discussion on tech, you've got the scale and you're developing stuff in-house, but and you go through a rigorous NOI return analysis. But how is that mix of buying existing off-the-shelf product versus developing in-house technology? How has that mix kind of shifted over the years, and how are you looking at that going forward?
Scott, it's primarily we're partnering with third-party developers and other companies to either embrace the product that they have developed, and or in some cases working with them to perfect the product and co-develop it. We are, at the end of the day, as I tell our folks, we're in the real estate business, and we're not in, quote, the technology business. And now, having said that, we're embracing technology pretty aggressively, but whether we taking that step to actually invest in the infrastructure that you need with programmers and others to actually invent the technology, I would suggest that we're only going to do that should we find an opportunity to do something that is truly differentiating in nature and truly unique. What we prefer to do is partner with developers who have developed this technology or working on it. Perfect. One of the things that's been interesting that we've learned is how different companies use technology in different ways. And I think that that's one of the things that we have been able to do while we're, if you will, buying the technology in many cases off the shelf. How we choose to use it, and then how we choose to integrate it into our existing infrastructure, tech infrastructure, can be the real differentiation. And I often share the story that we've been through two pretty big significant mergers, having acquired Colonial Properties about 10 years ago and Post Properties about 5 years ago. And in both cases, we were all in the same revenue management system, the same revenue management software. It was a third-party developed system and software, and we were operating in the same markets, operating in the same states, in the same business. But I can't tell you how differently we were approaching our use of that same tool. And so there is significant opportunity to tailor and customize a lot of these tools in various ways. And I think that's where the secret sauce is.
That makes sense. I appreciate it. Eric, you probably know our graduate students are really coming through this program. They already have great real estate experience, maybe transitioning different property sectors. Joining us today is Sam Penny. He's an incoming student. He has industrial experience, but he also has a lot of interest in redevelopment and I think the Florida markets. He had a couple of questions for you on those topics. Sam?
Yep.
Sure.
Thanks, Professor Robertson. Eric, just want to say thank you again for taking the time. This has been really informative. I think my first question in regards to the population growth in Florida is, what do you think sets Florida apart from other Sunbelt states as a rental market?
Well, Florida is a market that has enjoyed particularly strong job growth over the last 10 years. It shows no signs of really slowing. It's a very affordable state to both do business in and to live in. No state income tax, great outdoor venues, and a lot to do, high quality of life. And I think ultimately, much somewhat similar to a lot of the states, frankly, that we do business in. But one of the other things I would point to, though, that I think has really worked in Florida's favor in particular, is I think they've done a great job in with managing the fiscal needs of the state and both at the city level and the state level. Florida has the benefit of a lot of tourism and entertainment business coming into the state. It provides an opportunity to tax that form of business from people that are not necessarily domiciled in that state. And so you have a scenario where the state gets a lot of its tax revenue from people that don't live there. And so it creates a scenario that can make it hugely beneficial to living there and doing business there.
Great. Thank you. It's really helpful. The second question I had was in regards to the property repositioning that I know Robin mentioned earlier. What are some of the most memorable ways you have seen a property updated to maintain or increase its market appeal?
One that always comes to mind is a property that I remember years ago, it was probably 20 years ago. It was in Austin, Texas, and it's a property called The Woods, and it was in a terrific location, fairly close proximity to downtown, right on the river, great outdoor venue. But it was at the time, I guess it was probably 30 years old. So it's a 45-year-old property. We're talking about 8-foot ceilings, really old appliances. It was something that I would have never imagined we would have looked at. But we bought it for $10 million or so 20 years ago. We've put probably $17 million in it, and we could probably sell today for around $65 million. And it's just, the premise that location really matters is still true. And we can't put too much money into this property because we just keep raising the rents and because of the location. So that's, in a macro sense, but one of the things that's been interesting, given that we've been so focused on interior renovations for the last, 20, 25 years, is just the things that we've learned to sort of refresh the interior of an apartment unit without spending a lot of money, but you get a real wow factor from it, which is what is part of the variable that goes to contributing to rent growth. Things such as, cabinetry gets really old in apartments sometimes, particularly in the kitchen area. We've learned and perfected how to not replace the cabinetry, but just replace the doors. And in some cases, you don't even need to replace the doors. What you need to do is just put on a new doorknob. And you would be shocked at how much of an optic wow factor you can get from new doorknobs. And so one of the other things that we've learned is, in an apartment that may have 15 or 20 years worth of age on it sometimes, and you get repainting in between the turns. Sometimes the switch plates and the electrical plates, get ratted up a little bit, or they get paint on them. And so we always, when we were redeveloping the unit, we always were having to go in and replace those light switches and replace the plates. And that's expensive because you got to hire an electrician to come out and do all that. And one of our guys one time came up with an idea that we had adopted. And basically, we just went out and bought a very inexpensive plastic plate that you put over the existing plate. The switch actually goes inside, the old switch goes inside the new switch. And so you have a brand new face on it, and you haven't had to involve an electrician. And so it looks brand new, and we did it for a lot less money. So you just learn some things over the years to really, not spend a lot of money, but to really refresh the interior, which is what really creates the rent growth opportunity.
That's really helpful. Might actually help around my house, here and there. So I appreciate that.
Yeah, absolutely.
So you mentioned location, which raises a point. Obviously, location in terms of proximity to jobs, lifestyle things. But how important is location in terms of lease up? In the old days, I assume you relied a fair amount on kind of drive-by traffic. Is that how you're leasing these days, or is it pretty much on the internet?
No, it's almost, it used to be drive-by was one of our biggest sources of traffic. But yeah, now it's, I can't imagine anybody's coming in to lease an apartment. They've not done online research already. And the vast majority of the traffic that we get originates online at this point. And so that is our front door. Now the web, the internet is our front door big time. And how we posture our websites, the work that we do in our digital marketing group to be active in thinking about, if you're sitting in New York and say, show me all the apartments in uptown Dallas, how you have to maneuver, pay to be sure that your property pops up near the top of the list. That ball game has changed dramatically, and it's gotten very, very sophisticated. And you have to be very proactive in how you think about managing your digital marketing effort. It's gotten very competitive in that regard with the ILS systems and others. And then, of course, the online surveys and what people have to say about living there is something that, your Google scores. All that has just undergone significant change over the last, 10 years. And we spend a lot of time and energy on the digital world these days in terms of digital marketing.
So ballpark, what percentage of your employees are effectively IT people? And compare that to a few years ago. It's just...
Well, the budget's a lot bigger, I can tell you that for sure. We have roughly 2,500 associates that work for us. The vast majority, of course, are out at the properties. The biggest segment of associates that we have working for us are actually our maintenance service technicians, which is, there's only so much you can do to automate that kind of activity. When the air conditioning goes out, you still got to have somebody go out there and work on it. We have preventive, we monitor things a lot more actively now with technology. But in terms of our IT group itself, we have roughly about 80 associates that work in that group, that are very focused on not only tech support to our properties, people forget the password to they can't sign on, or whatever it is. As technology has worked its way into everyday lives, as we, we're just working through all getting on the Zoom call. Boy, when it works, it's great, but when it doesn't work, it can be so frustrating. And so, you've got and of course, when the tech doesn't work, it's not like, it's just a frustration. Depending on what it is, we're out of business. And so, we have to, business disruption and managing that requires a real commitment from a tech perspective. So that, and then as I've also said, we've had to spend a lot more energy and effort and focus on cyber protection and what we do in that regard as well.
Scott, I don't know how we're doing on time, but over to you.
Yeah, I think we're just about there. But what are your thoughts, Eric, on inflation? I know there's obviously a lot of talk about it. Maybe we're approaching peak inflation, and there's been different impacts, different property sectors. But what's your outlook and its impact on the residential space?
Well, we're certainly seeing evidence of it in terms of our own operating cost, and we've had to, whether it's maintenance supplies to a lot of different aspects. The labor market, of course, has also become very expensive and are more expensive and very competitive, I should say. And so we've had to respond to that. And so I think that we're seeing some pressure on the expense side, but the top line, the revenue line, has been so strong that it's more than offset the expense pressure. So resultingly, NOI growth is still very strong and very positive. And I think that a lot of the, I would suggest to you that as you head into a higher inflationary period, that residential real estate offers and provides some real advantages over other real estate asset classes. As I often tell our people, be really thankful that we're in a business where, people got to have it. I mean, shelter is a basic need. And so, people get to a point where they're seeing, pressures with disposable income. To some degree, people will tend to prioritize, their income towards, meeting their housing needs, which I think is helpful. And then, of course, the other huge advantage is the fairly short-term nature of our leases. And we reprice our entire portfolio every year, and so we're in a period of escalating pricing. And we can adjust to that at the top line fairly quickly. So, I think that residential real estate is, in my opinion, one of the best sectors to think about from an inflationary hedge perspective.
Thank you.
Well, I think sadly we're out of time. Eric, can't thank you enough. This has been fascinating and incredibly valuable to our students. So really appreciate it.